Have you ever heard someone say buy term life insurance and invest the difference? Or maybe you've heard the exact opposite. Whole life insurance is the best financial vehicle ever created. The problem is that both sides are usually speaking in absolutes. And whenever someone speaks in absolutes about finances, you should probably pay attention, because the truth is rarely that simple. I've spent over 12 years helping individuals, families, business owners, and professionals structure life insurance and retirement planning strategies. During that time, I've reviewed hundreds of policies, and what I've discovered is that most people don't have the wrong type of insurance. They simply have the wrong insurance for their goals. In this video, I'm going to break down the difference between term life insurance and whole life insurance, explain where each one fits, address some of the biggest misconceptions, and help you understand how to determine which strategy may be right for you and your family. Let's start with the most important question. Why do people buy life insurance in the first place? Life insurance exists because somebody depends on you. If something happened to you tomorrow, would your spouse be financially impacted? Would your children lose financial support? Would your mortgage still need to be paid? Would your business survive? Would taxes, debts, or financial obligations become someone else's burden? Life insurance isn't really about death. It's about protecting the people who are still alive. Once you understand that, it becomes much easier to understand which type of life insurance may fit your situation. Because term life insurance and whole life insurance are designed to solve different problems. Let's begin with term life insurance. Term life insurance is exactly what it sounds like. You purchase coverage for a specific period of time or a specific term. Typically, those terms are 10, 15, 20, or even 30 years. If you pass away during that period, the insurance company pays the death benefit to your beneficiaries. If the term expires and you're still living, the coverage ends. Think of term insurance like renting a house. You have access to the protection while you're paying for it, but once the contract ends, the benefit goes away. The biggest advantage of term insurance is cost. For relatively low premium, you can obtain a large amount of death benefit protection. For example, a healthy individual may be able to attain $1 million or more of life insurance coverage for a fraction of what permanent insurance would cost. Because of this, term insurance is often a great fit for young families, parents with young children, individuals with mortgages, people who need a large amount of coverage on a limited budget. The goal is simple: maximum protection at the lowest possible cost. And for many families, that makes perfect sense. But term insurance does have limitations. At some point, the term expires. When it does, the policy may end entirely, or the premiums may increase dramatically if you want to continue the coverage. Additionally, your health may not be the same 20 or 30 years from now. You may develop medical conditions that make new coverage more expensive or even difficult to obtain. So while term insurance is an excellent protection tool, it was never designed to solve a permanent need. It's designed to solve a temporary need. So let's talk about whole life insurance. Whole life insurance is considered permanent insurance. As long as the policy is properly funded and maintained, it can remain in force for your entire life. Unlike term insurance, whole life insurance has two primary components. The first is death benefit. Just like term insurance, this is the amount paid to your beneficiaries when you pass away. The second component is called cash value. A portion of your premium goes towards building cash value inside the policy. Over time, that cash value grows. Depending on the policy design and carrier, that growth may come from guarantees, dividends, or a combination of both. This is one reason why whole life insurance is often used for more advanced planning strategies. Individuals may use whole life insurance for estate planning, legacy planning, business planning, asset protection, liquidity planning, conservative accumulation, intergenerational wealth transfer. The biggest mistake people make is comparing whole life insurance solely on the cost of insurance. If all you're comparing is cost, term insurance will almost always look better. But that's like comparing a pickup truck to a luxury SUV and saying one is better because it's cheaper. They're built for different purposes. Whole life insurance was never designed to be the least expensive option. It was designed to provide permanent protection while simultaneously creating an asset that can accumulate over time. Now let's address some of the biggest myths surrounding both products. The first myth is that term insurance is always better. That's simply not true. Term insurance may be better for certain goals. If someone needs the largest amount of death benefit for the lowest premium, term insurance often wins. But that doesn't automatically mean it's the best solution for every person. The second myth is that whole life insurance is a scam. This statement usually comes from someone who either had a poorly designed policy or has never truly studied how permanent insurance works. Can whole life policies be structured poorly? Absolutely. Can someone be sold the wrong policy? Absolutely. But that doesn't make the concept itself flawed. Every financial product can be used correctly or incorrectly. The third myth is buy term and invest the difference. Now, this is arguably the most popular statement in the financial industry, and mathematically, it can absolutely work. The challenge is that most people don't actually invest the difference consistently for 20, 30, or 40 years. They spend it. The strategy only works if someone has the discipline to follow through. Some people do, many people don't. The fourth myth is that whole life insurance is an investment. Whole life insurance is first and foremost insurance. Can it accumulate value? Yes. Can it become an asset? Yes. Can it play an important role in a financial plan? Absolutely. But its primary purpose remains as protection. When people evaluate it solely as an investment, they often misunderstand what it was originally designed to accomplish. Now let's discuss how I help clients determine what may be appropriate for them. When someone meets with me, I don't begin the conversation by asking whether they want term insurance or whole life insurance. Instead, I ask what they're trying to accomplish. If someone is 35 years old, has young children, a mortgage, and needs the coverage, possible while staying within a budget, term insurance may be an excellent solution. If someone is a business owner, a high-income professional, or an individual focused on estate planning, liquidity, legacy, tax efficiency, or long-term wealth transfer, permanent insurance may deserve serious consideration. And many times the answer isn't one or the other. Many successful families have both. They use term insurance to protect temporary risks while simultaneously using permanent insurance for long-term planning objectives. The right strategy isn't about picking a side. It's about matching the tool to the objective. If there's one thing I hope you take away from this video, it's this. Term insurance and whole life insurance are not competitors. They're tools. A hammer isn't better than a screwdriver. They're simply designed for different jobs. The biggest mistake I see isn't buying term insurance. The biggest mistake isn't buying whole life insurance. The biggest mistake is purchasing something you don't fully understand. That's why education should always come before implementation. Understand your goals, understand your options. Then choose the strategy that aligns with what you're trying to accomplish. I've been a financial professional specializing in life insurance and retirement planning for over 12 years. During that time, I've helped individuals, families, business owners, and professionals review and structure millions of dollars of life insurance coverage. One thing I've learned is that there's no one-size-fits-all solution. The right plan depends on your situation, your objectives, and the people you're trying to protect. If you'd like a professional review of your existing policies, or if you're considering life insurance and want guidance on whether term life, whole life, or a combination of both may be appropriate for your family, I invite you to schedule a consultation. You can book a meeting directly with me or a licensed professional from my team at Yellowbrick Financial. We'll review your current situation, identify potential gaps, and help design a strategy tailored to your family's needs and long-term goals. At Yellowbrick Financial, our philosophy is simple. Earn, protect, grow. First, build wealth, then protect what you've built. Finally, position your assets to grow efficiently for the future. If you'd like to get started with a complimentary consultation, click the link below, schedule a consultation, and let's see if we can help you build a stronger financial foundation for yourself and the people you care about most.